I'm going to give you a complete real estate transaction, all real numbers, just got off the phone with the realtor, just got off with the loan guy. I'm going to show you exactly how to calculate it. It's no money down. This duplex is listed for $219,000. It receives $900 per month for each side. Each side is a 2-bedroom, 1-bath. After I collected all the information, I got off the phone, I called the lender, collected all their information. The property is listed for $219,000. It's a duplex, 2-bedroom, 1-bath for $900, 2-bedroom, 1-bath for $900. I'm going to assume an accepted offer of a $200,000. That does not mean I'm starting with a $200,000 offer. I'll offer considerably less, but I'm calculating worst case scenarios on these numbers. Let's break down the expenses. First thing I always do is calculate the vacancy rate. The realtor said these units rent very quickly, so they don't have much of a vacancy rate. I don't care. This is my minimum vacancy rate for every property, no matter what. 8.3% means that 1 month out of the year it does not rent. So the effective gross income I'm going to have per month on average throughout the year is $1,650 per month. Principal and interest is $917. Look over here. That's at a 6.875% interest rate. I said, hey, I don't want to pay points. If I do 0 points, what's the rate going to be? He quoted me 6.875. He said if I paid 1 to 2 points, I'd be about 6.5% interest. So in this scenario, I want to see, can I get this property for as minimal cash down as possible? Principal interest on a 30-year rate and term. Taxes are $85. Insurance, $90. Leaves us with $558 per month, $100 a month in maintenance. That's going to leave me with $458 a month. Okay, so that $458 cash flow would be available to us if we put 20% down on this particular property. 20% on $200,000 is $40,000 down. This particular lender will allow a seller carryback for that other 20%. So I'm going to run the numbers with a seller carryback of the remaining 20%. At the bottom, I'll show you if you don't use seller carryback what it looks like. $458 is our disposable cash flow after principal, interest, taxes, insurance, and maintenance costs. Second position loan, $333. What $40,000, second position, I'm going to assume 10% interest only payments. That will then leave $125 cash flow per month. By the way, this is called a no money down purchase. What about closing costs? I'm going to seek 2% seller concession. What is that? That is the amount of money I can ask the seller to give me at closing. So I'm going to seek 2% seller concession. And then I'm going to get a monthly rent credit. For now, I'm assuming that I close in the middle of the month. So at escrow, you get that as a credit. I'm also going to get deposits as a credit. The rent rolls and the deposits you'll actually confirm during the inspection period. You request what are called estoppel certificates. It's just a fancy word for official validation that here's what the rent rolls are, here's the rental contracts, and here's what the deposits are. I'm also going to get a property tax credit of $477. So at closing, I have this much coming to me. Now those are credits, and I want to use those because I do have closing costs. The inspection is $450. Loan fees are about $1,000. Appraisal is going to cost $995. And escrow fees somewhere around $2,500. Closing costs to be $5,000. Closing costs may vary depending upon where you're at. Credits are $7,177. Cost of $5,000. What does that mean? At the time of this closing, I would be getting in my hand $2,000 to buy this property. No, some lenders limit the amount of cash that a buyer can actually get back at closing. I would probably use that $2,000 to buy down the interest rate. It'll take my principal and interest to $867. So that's now an extra $50 per month in cash flow, or $600 per year that I get. Let's say you want to put $40,000 cash down. Take your total cash flow for the year, $6,096, divide that by the $40,000 cash you put down. That's a 15% cash on cash return. At the end of the year, you're going to get depreciation. If you're classified by the IRS as a full-time investor, then the depreciation from this property will pass through to your personal taxes. Let's see what it looks like. I bought this property for $200,000. I'm going to assume about 20%, which is $40,000, is equal to the land value. We can't depreciate land. That's going to leave me $160,000. Now, just a simple straight line depreciation, you're going to take the value of the building and divide that by 27.5 years because this is residential. And that gives you $5,818. Your income on this property is $6,096. So if you bought this property with $40,000 down, all your income will be wiped out by depreciation, assuming you're a full-time investor. Or I give you a method to buy this property with no money down, and your cash flow per year would be $1,500. This is Dave with Real Estate Scoops. I hope this helps. And if it does, don't forget to like and follow.